somewhere in Washington, a decision is being finalized that could quietly rewrite the rules of the global silver market, not with headlines, not with fanfare, but with a signature, a policy memo, and a deadline most investors don't even know exists. While paper silver trades one price on a screen, physical silver, the real metal in real vaults, is already trading another, and the gap between those two numbers is growing. Why would a government quietly move to guarantee a price floor for a metal most people still think of as just jewelry or the poor man's gold? What do they know that the public does not? By the end of this video, the answer may change how you think about the next 12 months. Stay with this story until the very end. It matters more than it appears. Welcome back to Precious Metals Intelligence, a channel built for those who prefer to understand the why behind economic events before everyone else catches on. If you value clear thinking over noise and long-term wealth protection over short-term speculation, you are exactly where you should be. It started quietly. No breaking news alert, no emergency broadcast, just a gathering of world leaders, a policy speech, and a room full of officials taking notes. Most people never heard about it. Most people still haven't. Earlier this year, a senior U.S. official stood before representatives from more than 50 nations and outlined a plan that would, in time, touch nearly every corner of the global economy. The subject was critical minerals, the raw materials that power modern defense systems, modern electronics, and modern infrastructure. The plan was simple in concept, but massive in scale. The United States and its closest allies would begin building a coordinated price floor system for the materials considered essential to national security. At first glance, this seemed like a story about rare earth elements, cobalt, lithium, the materials most people associate with military technology and electric vehicles. But buried within this policy shift was something far more surprising: silver. A metal most investors think of as gold's smaller, more volatile cousin, a metal often treated as a hobby investment, not a strategic asset. For the first time in modern history, silver was being formally treated as a critical industrial and defense material, not just a shiny metal people buy in coin form, a metal the government now considers essential to national security. This alone would be significant. But what happened next made the story even more puzzling. Instead of rallying on this news, the price of paper silver, the silver traded on major exchanges tied to futures contracts rather than physical bars, actually fell. It dropped sharply in the weeks that followed. For many investors watching the headlines, this made no sense. If silver was suddenly this important, why would the price fall instead of rise? This is the first clue in a much larger story. And it is a clue worth understanding carefully because it reveals something most casual investors overlook. Financial markets do not always react to policy the way people expect. Large trading algorithms often treat government announcements as short-term uncertainty, not long-term opportunity. When new rules are introduced, some funds sell first and ask questions later. This creates a strange temporary disconnect between what is actually happening in the real world and what the price on a screen appears to say. While paper prices dipped, something very different was happening in the physical market. The market for real, tangible silver bars and coins, the kind people can hold in their hands. In parts of Asia, silver began trading at a striking premium above the official exchange price. In parts of Europe, dealers reported a surge in demand they had not seen in years. In the Middle East, buyers were paying well above spot price just to secure physical metal. In other words, while the paper price said one thing, the real world was saying another. This is the heart of the story now unfolding. A growing gap between the price shown on trading screens and the price people are actually willing to pay for real physical silver. A gap that did not exist in ordinary times. A gap that appeared almost immediately after this policy shift became public. Why would this happen? Why would a government-backed price floor cause confusion in the paper market while creating urgency in the physical market? The answer lies in understanding exactly how this new system is built and why it was created in the first place. It is not a simple subsidy. It is not a temporary intervention. It is something far more structural, with mechanisms designed to operate for years, not months. To understand what is really happening and why calm, careful investors are paying close attention right now, it is necessary to look deeper into the architecture behind this policy. Not the headlines, not the speculation. The actual mechanics being built behind the scenes. To understand why silver is behaving so strangely, it helps to step back in time. Government price guarantees are not a new idea. They have existed before, in different forms, during different periods of crisis. During the Second World War, the United States relied heavily on price guarantees for critical materials. When national security depended on steady supply, the government stepped in to remove uncertainty for producers. It told companies, in effect, build the capacity, and we will guarantee the price is worth your investment. That same thinking quietly returned in recent years. In 2025, the Pentagon arranged a 10-year price floor with a rare earth magnet producer, guaranteeing a price nearly double the market rate at the time. Few people outside the industry noticed. But those who did understand what it meant, it was a signal, a test case, a sign that this kind of policy tool was back in active use. What is happening now with silver is being described by officials as something larger and more coordinated. It is not one deal with one company. It is a broader framework, built across multiple government agencies, designed to protect an entire supply chain from foreign manipulation. This framework has been given a name inside policy circles, tied to a wider alliance between allied nations working to secure their mineral supply outside of foreign control. To understand how this system actually works, it helps to break it into 3 simple parts. The first part is reference pricing. Instead of picking a number randomly, the government is using advanced data modeling to calculate what a strategic mineral should reasonably cost. This calculation factors in fair labor standards, environmental compliance, and the true cost of refining. The goal is to strip out artificially low prices created by foreign producers who do not follow the same standards. In simple terms, the government is trying to calculate a more honest price, one that reflects the real cost of responsible production. The second part is an adjustable tariff system. If a foreign country tries to flood the market with cheap silver in order to undercut Western producers, tariffs rise automatically to close that gap. This removes the incentive for economic pressure tactics. It protects domestic and allied producers from being undercut by artificially cheap imports. The third part is perhaps the most important. It is the idea of a buyer of last resort. If private demand weakens during an economic downturn, the government commits to purchasing production at the guaranteed floor price. This single guarantee changes everything for a mining company. It removes the single biggest fear an investor in mining infrastructure has, spending billions of dollars to build a mine, only to watch a foreign competitor crash the global price the moment production begins. Understood together, these 3 pillars form something far more permanent than a one-time announcement. They form an entire support structure, a structure meant to protect long-term investment in critical materials, silver included. This explains why the paper market reaction was so confusing at first. Wall Street trading systems are built to respond to short-term signals. New regulation often looks, on the surface, like new uncertainty. Algorithms are not designed to instantly understand multi-year strategic frameworks. They are designed to react quickly to headlines. By now, a reasonable question emerges. Why silver? Why would a metal so often associated with jewelry, tableware, and casual coin collecting suddenly become a matter of national security? The answer begins with a simple scientific fact. Silver possesses the highest electrical and thermal conductivity of any element on Earth. No other metal moves electricity as efficiently. This single property makes silver difficult, sometimes impossible, to fully replace in high-performance technology. Modern defense systems depend on this property constantly. Guided missile components use silver. Military radar systems use silver. Advanced communication equipment relies on it. Every layer of modern defense technology, in some form, touches this metal. But defense is only part of the story. Silver plays an equally critical role in civilian technology. It is essential in solar panel production, a sector expanding rapidly around the world. It is essential in electric vehicle electronics, another sector growing at a fast pace. And increasingly, it plays a growing role in the semiconductor and artificial intelligence hardware industry, where efficient, high-performance conductivity is not optional. It is required. In other words, silver sits quietly at the center of nearly every major technological trend shaping the next decade. Defense modernization, renewable energy expansion, electric transportation, advanced computing. All of it depends, in part, on this one metal. Now consider the supply side of this story, because this is where the pressure truly begins to build. Unlike gold, silver is rarely mined on its own. Roughly 70% of global silver supply comes as a byproduct of mining other metals, primarily copper, lead, and zinc. This creates an unusual limitation. Even if silver prices rise sharply, mining companies cannot simply increase silver production on demand. Supply is tied to the production schedules of entirely different industries. If copper mining slows, silver supply slows with it, regardless of how much silver is actually needed. At the same time, global demand for silver has been outpacing supply for several consecutive years. Industry researchers have reported a widening structural deficit, meaning the world is consistently using more silver than it is producing. This is not a temporary imbalance caused by a single event. It is a gradual, ongoing shortfall that has been building quietly for years. Adding further pressure to this situation, one of the world's largest silver-consuming nations recently introduced strict export licensing rules on its own silver reserves. This move effectively locks a significant portion of global supply inside that country's borders, reducing the amount of silver available to the rest of the world. For nations that depend on steady industrial and defense-related silver supply, this created a genuine strategic concern. This is the deeper context behind the recent policy shift. It was not simply about protecting an investment asset. It was about protecting a critical industrial input that modern defense and technology systems cannot function without. When a nation realizes it does not have secure, reliable access to a material required for its military systems and its technological future, it tends to act, quietly, methodically, but decisively. This explains why silver was placed alongside materials like cobalt and rare earth elements in the new critical minerals framework. It is no longer viewed primarily as a financial asset traded by investors. It is now viewed as a strategic resource required to maintain national security and technological independence. For everyday investors, this shift carries an important lesson. Markets often continue to price an asset based on its old identity, long after its true role has changed. For decades, silver has been priced largely as a speculative, volatile investment metal. But if governments are now treating it as a strategic necessity, similar to oil, uranium, or rare earth elements, then the old pricing logic may no longer apply. This raises an important question, one that becomes clearer in the next part of this story. If physical silver is becoming harder to secure, if industrial demand keeps rising, and if governments are moving to guarantee its long-term price, then what happens to the gap between the official trading price and the real-world price people are willing to pay for physical metal? By this point in the story, a clear pattern has started to form. Silver has been reclassified as a strategic material. Its industrial demand keeps climbing, its supply remains structurally limited, and a coordinated government pricing framework is being built around it. Yet the price shown on major trading exchanges has not fully reflected any of this. To understand why, it helps to look closely at what has actually been happening in the physical market, separate from the paper market. When the policy framework was first made public earlier this year, the price of paper silver dropped sharply. It fell toward the mid-$60 range per ounce. On the surface, this looked like a rejection of the entire story. If silver was truly becoming this strategically important, why would traders sell it? The explanation lies in how paper markets actually function. Paper silver refers to contracts, not physical metal. These contracts are traded rapidly by large institutions and automated trading systems. These systems are built to react to short-term signals, not multi-year strategic frameworks. A new government policy often looks, in the short term, like uncertainty, and markets tend to sell first when faced with uncertainty, even when the long-term implications are positive. But while paper prices fell, something very different was happening in the physical market, the market for real, tangible silver that people and institutions can actually hold. On one of the world's largest physical metals exchanges, silver began trading at a striking premium above the official spot price, at one point reaching a difference of more than 30%. In dollar terms, physical silver was trading well above $100 an ounce, even while paper contracts showed a much lower number. This pattern was not limited to one exchange. In Germany, physical bullion dealers reported a sharp rise in retail demand, describing buying activity they had not seen in years. In Dubai, physical silver bars were commanding premiums of 15% or more above the spot price. Larger silver bars, the kind typically purchased by serious investors and institutions, were reportedly selling even further above the listed exchange price. This is the core of the divergence. Two prices exist for the same metal, moving in two different directions. One price lives on a screen, driven by contracts, algorithms, and short-term trading behavior. The other price lives in the real world, driven by people and institutions who actually want to hold physical silver in their hands. This divergence tends to appear during periods of deep structural change, moments when markets have not yet caught up to a new reality. And there is a specific reason many analysts believe this gap may not close on its own, at least not in the direction paper markets currently suggest. The United States Department of Commerce has been conducting a formal review under a section of trade law that allows the government to establish minimum import prices and enforceable tariffs on critical materials without requiring new legislation from Congress. This review reaches its final decision window in the middle of this year. Once this review concludes, the executive branch gains the legal authority to begin enforcing the pricing framework discussed earlier, including reference pricing and adjustable tariffs. This does not mean an official price floor will be announced immediately. Implementation is expected to be gradual, shaped by pushback from parts of the mining industry and hesitation among allied nations concerned about trade disruption. But the legal foundation for enforcement will be in place. This creates a narrow window in time, a period where physical silver can still be purchased at a price shaped largely by paper market trading, before enforcement mechanisms begin influencing the broader pricing structure. Once formal enforcement begins, the relationship between paper prices and physical prices may shift in ways that are difficult to reverse. This leads to the final and most important part of this story. Not what has already happened, but what this divergence may mean for individuals trying to protect their wealth in the months ahead.